this was early stage or earlier. Next one is Western Copper and Gold. Paul?
Oh, we're starting in the middle of my presentation. I like it.
Okay. Western Copper and Gold. I think most of you know the company. Welcome to Frankfurt. Oh.
Where am I pointing?
It works.
It started in the middle.
Okay. So this is another dimension because you got 14.5 million ounces.
21.
21.
Don't undersell me.
Was on your website, 14.5, and a lot of copper.
That's measured and indicated, yeah.
Yeah, measured and indicated 14.5 million ounces, and I think copper 7.6 billion pounds. Yeah. Okay, please start.
All right. Thank you, everybody. Thank you for coming. There's a few presentations up front there if you want to grab one. Just real simply to put you into perspective, Western Copper and Gold has one asset, the Casino Copper Gold Project, located in the Yukon in Canada. This is a large copper gold porphyry. This has been a big year for us. We just put out a PEA, and we just brought in Rio Tinto as a strategic investor. I will be making forward-looking statements, so please review this before making any investment decision. So just real quickly on the structure of the company, sort of two takeaways from this slide that I'd like you to make. First of all is our cash position. So mid-year, we're sitting on approximately $58 million Canadian. We expect to end the year around 50 million. So in terms of where we are, and I'll get into this, but we're in the position right now where we're finishing off the engineering and getting into permitting. This $50 million is sufficient for us to complete all of the engineering and all the permitting that is required on the project. So we're essentially sitting with enough cash to bring the project to fully shovel ready. Share price as of yesterday was a little under $2, which gives us a market cap of around 300 million. In terms of shareholders, I'll talk briefly about Rio Tinto, but you can see there's some good blue chip US funds with Fidelity and Franklin and Copernic. Board and senior management hold a little under 5% of the outstanding shares. So one of the big things this year was bringing in Rio Tinto. So Rio Tinto made a 25.6 million strategic investment in Casino. And really, the goal of this investment for Rio Tinto was to enable them to run essentially a due diligence program on the project. So as part of this, we've set up a technical committee which they sit on. They have an observer on the board, and that can turn into a board member if they increase their shareholding up to 12.5%, and they second people into the project as well. Importantly is that all of these rights are in place for 18 months. So this is really come in, do some work, take a look at the project, and make a decision about a further investment in the project. So when we look at that work, where are we? So that investment was May of this year, just before the field season started. So the field season is now complete. We did the the metallurgical and geotechnical drilling, some resource confirmation drilling, a little bit of exploration finished off. There were some gaps in our soil sampling on our project, so we finished that off. A little bit of exploration, a bunch of scanning of old core, and then work in progress. Like everyone, we're still waiting for assay results. A lot of work on community and First Nation engagement, review of the regulatory process. So where this scope of work and diligence is really sitting is what's remaining is this metallurgical program. So we'll see how things go, but we fully anticipate that next year we'll be sitting down with Rio and discussing next steps. So let's talk about the project. So this is one of the largest copper gold projects in Canada. Just finished a PEA. Located in the Yukon, we love being in the Yukon. Yukon has turned into a real vibrant mining district with 3 operating mines. And we as a company have continued to add value. We came up with a new resource last year. This year is the PEA and brought in Rio. We've launched our feasibility study and we'll be shortly launching permitting. So here's the headline numbers. Adding the inferred and the measured and indicated, you're looking at 21 million ounces of gold, 11 billion pounds of copper. So what's important is when you look at the revenue distribution or the contained value in the ground, you're looking at 40% of your revenue from copper, 40 from gold, and about 20 from moly. So this is a true copper gold. So you're going to, if you look at just the copper assay, it's going to look a little low. You look at the gold assay, a little low. No one looks at moly. But when you add them all together, that's why this project works. And as I'll show you from the PEA, has very, very good, strong economics. In terms of size, just to save some time, I'll point you out to the copper equivalent on the right-hand side there. You can see that we're about 3 or 4 times the size of Filo, maybe double a Jose Maria. We're essentially almost the size of SolGold's Cascabel. And in the gold perspective, again, this is interesting just to look at gold. Again, comparing us to SolGold, you can see we've got 21 million ounces of gold, they've got 24. So again, sort of very, very similar in terms of contained gold. And then in terms of gold equivalent, we're actually bigger than a Donlin. So significant endowment of minerals in this deposit. So let's talk about the deposit. When I have more time, I spend more time on slides like this, but that's the top of the deposit. Quick takeaway there is that this part of the Yukon's big. It's probably the size of Germany. But this part of the Yukon, fairly arid, not very mountainous, gentle rolling hills, easy place to build a mine. So from our PEA, the highlights are here. We looked at a 2-phase development. This is a large resource. So we looked at a 2-phase development. Looking at phase 1, and this is at $3.35 copper and $1,600 gold, and this is from a PEA that came out in June. So very, very recent. You're looking at a net present value of $2.3 billion, essentially 20% IRR, payback of 3 years, and all that's after tax. One of the key reasons why this project works as well as it does is the strip ratio. As you'll see, it's not particularly high grade, but it's bulk tonnage, low strip ratio, and that's what makes it work. Strip ratio of under 0.4 to 1, that's a best in class. Looking at phase 2, so this is adding on a second tailings facility and that adds essentially another 22 years of mine. That adds, brings our cash flow, it adds about $4 billion of cash flow. And that still is only 2/3 of the overall resource. There's still more resource, and this thing is still open at depth. So this is why people love these copper porphyries. You mine them for 50, 75, 100 years. This is fairly typical for this type of geology. So what's new? We did have a dated feasibility study on this, so this was an update. So obviously the updated resource from 2020 is important. Updated gold heap leach, a little bit on the access road, which I'll get into. But really the biggest change was on the tailings facility. And the tailings facility, I think everyone probably that has been following mining has followed that there's been some lots of scrutiny with tailings facilities. We sat down with the First Nations, the regulators, for a year and a half, redesigned the tailings facility. That's what's gone into this PEA. And this is critical for 2 reasons. 1 is to bring the community and the First Nations in the area on side, and 2, to make sure that there's a clear path through permitting. The resource itself, there's no pre-strip, it's right at surface. The surface, which is shown there in sort of the yellow, goes onto a gold heap leach. That's around 220 million tons at 0.3 gram per ton gold. Beneath that is where the main value is. And you can see there's 2.2 billion tons at 0.36 plus another 1.4 billion tons in inferred, so 3.6 billion tons of mineable material there. Importantly, though, is the core zone. And the core zone, which is shown right in the middle there, that's a breccia. It runs quite a bit higher grade, and that's where we start mining. So when you look at the grades as you begin mining, you can see the first 4 years, your grades are 0.72 copper equivalent. And then that first billion tons is 0.5 copper equivalent. And then, adding in the second billion tons, you're down to sort of 0.4. And if you look at these types of mines just south of us in British Columbia, that's what you see. Copper Mountain, Gibraltar, Highland Valley, these are all mines that have been operating for 20 plus years. You can see they're all mining 0.2 to 0.3 copper equivalent. Mount Milligan, Red Chris, these are newer mines. They're sort of in the 0.5. So we're right in that sweet spot, exactly where operating mines that are operating right now in terms of grade. A little bit more about that first 4 years. You're looking at cash flows over that first 4 years, pre-tax here, of over $1 billion a year for 4 years. I mean, it throws off, because of that, it's very simply because of that higher grade. If you look at production, and if, again, just because you've got such a mix of metals here, it's better to talk equivalent. In terms of gold equivalent, this is essentially 1 million ounces of gold equivalent per year over that first 4 years, and then it drops down through the life of mine. Looking at the economics, if you pick where we are today, which is right above that box there at $1,800 gold, $450 copper, you're looking at a $4 billion net present value. So we've added $2 billion to the net present value from that base case and an IRR of 26%. Capital cost is 3.2 billion Canadian or 2.5 billion US. I mean, this is a big mine, but if you look at that capital cost for this type of project, this is actually a relatively modest capital cost. One of the big copper mines being built right now is Quellaveco in Peru, Chile. And by Anglo American, the capital cost on that is 5 billion US. I mean, we're sitting about half that. Cash costs, mostly because of that high byproduct credit, puts us at the bottom of this curve, but that, of course, is very attractive. And then looking at the second phase development, really the second phase development is about adding cash flow. As you can see, it adds around $4 billion of cash flow. Interestingly, that ace up our sleeve, the reason why this project works as well as it does, which is that very low strip ratio, still stays very low. I mean, it's 0.38 over the first phase, and then it's less than 0.5 at 0.47, even through the second phase. In terms of valuation, I mean, we're sitting at a fairly good valuation here. I mean, we're, in terms of the market cap per NPV of the project, we're sitting a little over 10%. Obviously, there's some special cases up there at much higher, but really, when I look at some of our peers, they're sort of in the sort of 0.2 to 0.3. So we've certainly got lots of room to move. The other way to look at this is cents per pound of copper equivalent in the ground. We're sitting at a little over a penny. So I mean, again, when you look at some of the comparables, sitting at I would argue, fairly undervalued position. A little bit about infrastructure. We had a great announcement. News release came out 2 days ago. The government came in 2017, announced that they would build part of the road. Like all governments, great at making announcements, not necessarily good at delivering. In this case, they actually delivered. They awarded the contract. As I said, if they don't build the road now, they get sued by the contractor. $30 million for the first section of the road, so this is going forward. Other infrastructure, because people always talk about the Yukon, well, what about the infrastructure? Well, we're looking at using liquefied natural gas to power. That's such a good idea. That's exactly what the city of Whitehorse is doing. In terms of port, we've got the port of Skagway, currently being used by Minto. So already a good history of being used before. So real quickly, I've got 10 seconds left, but a little bit about the Yukon. ESG, we've got a great relationship with the First Nations. They've worked closely with us on our BAT study. We've got cooperation agreements with them. Just a little bit about the area. Right next to us is Newmont. Surrounding us is White Gold, which has Agnico and Kinross as major investors. And we've got Teck in there as well. And of course, we've got Rio. So that sort of hits it up. I mean, just hitting the last thing there. I mean, really, obviously, what happens with Rio is a big part of the story. But also, $50 million is what we're going to start 2022 with. Driving towards the feasibility study, just brought in a new VP to help us drive forward the permitting, so lots of runway to move that forward as well. Thank you.
Maybe just 2 short questions. Timetable for feasibility study?
Feasibility study is due Q2 2022, so 6 months. Well, 6 months in a month, I guess.
Okay, and what will Rio do?
What will Rio do? Well, if I had that answer, then I wouldn't be here talking, I guess. So,
Yeah.
Yes. Well, I don't think there's any arguments not to invest in the company. I mean, the 30-second investment thesis here is that, Rio doesn't want to have 8% in this company. They want to own the project. They're doing the diligence. We're mostly through that. I mean, I think we'll be sitting down next year and negotiating. But even if that doesn't happen, we've got $50 million in the bank, a good project, and we'll keep driving it forward.
Okay.
Any other questions? All right, perfect. Thank you.
Thank you very much. Paul will be here. So if you're